Hi there, my name's Logan Leone, and today I will be talking about our mortgages and their finances. So, what does a mortgage finance mean? Basically, a mortgage is a massive loan for a piece of real estate or property. Um, these loans uh, use said real estate or property as collateral in case you default on the loan. Basically, you can't pay the bill. So you better pay your bills. Usually, you have to pay that back between 5 to 50 years, with 30 years being the most common. I saw a 50-year loan on the internet, so that's what I'm going with. Interest rates, they can be fixed or they can vary throughout the years. Usually, it's a good idea to get a fixed one because it doesn't change throughout the years. So let's say uh, you get a fixed interest rate for 5%. It's going to say 5% 10 years from now, 50 years from now. It doesn't matter. Whereas a variable finance, next year it could be 5%, like when you first got it, or it could be up to 8%, or it could be down to 3%. It just, it's a gamble. So go with a fixed one. Plus, you can always refinance and get a better interest rate lower or later on. Now, who are they for? Well, very few people, at least that I know, can outright buy a house, so they need to borrow the money. They also are a fantastic way to build up your credit score. That being said, you do need to have a credit score to get one. So until you're ready, start building one up now, and make sure that it's as high as you can make it, because the higher it is, the better off interest rate you will get. Now, what's the downside? Well, usually you're stuck paying off that for a few decades. When you first start paying it off, most of your payments are going to be the interest rate first rather than the original amount. So let's take the scenario. You take out a $100,000 loan with a 5% interest rate and a term of 30 years. Now, your monthly interest rate is going to be $537 a month. But for the first few years, it's only about $120 is going to go to the original 100,000. The rest of it is just paying off interest. That being said, as the years go on, that number switches. So more and more of the original amount gets paid off as opposed to interest. Now, what can I do to make things easier for myself? Well, in the short term, nothing. Just make sure you have a decent down payment, and a halfway decent credit score, and that you can pay that bill every month. That's a big deal. In the long term, you can always refinance the loan. Say you got the loan at 6%, 5 years, and then 5 years go by, 10 years even, and you can now refinance it to about 5%. Now, literally save you tens of thousands of dollars that you can use for paying off your children's college or whatever. Eventually, when you do sell it off, sell it when you can make a profit, and preferably at a time when things are going well for sellers. Now, some words of wisdom. Mortgages are a necessary evil that we must deal with in our society. Uh, you need to pay them off as quickly as you can, and refinance it when you see interest rates drop. So, put in an extra $100 or $200 a month for every mortgage bill you have, because it will pay off in the long run. Sell it out at a profit. You can use that extra money to pay for another down payment for another house or for something else. And finally, when you're looking for a house, don't take forever to look for a good rate, I mean, do shop around, but you know, make sure you're getting the best interest rate that you can, but don't take 20 years to do it. And remember, the less that you spend, the better off you'll be.